Hello, and welcome to the Money and Banking Law Podcast with Joe Silvia, brought to you by Duane Morris, an international law firm with roughly 30 offices and 1,000 lawyers all over the world. I'm your host, Joe Silvia. I'm a former Federal Reserve lawyer who represents banks, fintechs, and financial services clients on M&A, payments, and regulatory matters at Duane Morris. I'm also a core member of our banking, fintech, and digital assets and blockchain practices. Now, while we can't provide legal, financial, investment, or tax advice on the podcast, our goal for the Money and Banking Law podcast is to inform and educate our clients and friends on both the fundamental concepts and structure of the banking ecosystem, as well as critical developments in the law and regulation of money and banking. Thanks for joining us today. As always, if you have any questions from any of our podcast episodes, please reach out to me at jsylvia@duanemorris.com. On this episode, we're talking about Vice Chair for Supervision, Governor Michelle Bowman's opening remarks at the Federal Reserve Bank of Atlanta's 2026 Banking Outlook Conference. Before we jump into that, I wanted to give a quick shout out to the folks over at millionpodcasts.com. I was really surprised and just really humbled by the fact that they recently added the Money and Banking Law podcast to their list of the top 50 banking podcasts. It was unexpected, but very welcome and just an amazing acknowledgement of all, the work that it takes. But big shout out to millionpodcast.com. Head over there, take a look. They've got a lot of great lists with other great podcasts, great content. Definitely encourage you to do that. And again, a big shout out to uh, the folks over there, and they're one of the founders, or the founder, Anuj. Really great guy. Appreciate all the work that they're doing. Anyway, back to regular scheduled programming. So I want to walk through and really, read but comment on Vice Chair for Supervision Bowman's remarks. They're interesting, nothing too ground shaking, but a reiteration of where the Fed really is at this point in terms of its view on certain supervisory matters. So a good reminder as to what is forthcoming from the Federal Reserve. Governor Bowman has been serving as vice chair for supervision since I think June of 2025 or so. And she remarks that she's one of the first to, or the first vice chair for supervision to hold that position with the credentials that she has from a community banking background. So she starts and she says, I'll begin by describing what's next on the horizon. Let me start with our progress and then path forward. Important guiding principle is regulatory and supervisory tailoring, which she's talked about many times before. We've talked about on the podcast before, but really is tailoring the approach from a regulatory rule writing and supervisory perspective, which is the examination perspective. She says this requires adjusting our approach to the risk that banks of different size and complexity pose to the financial system, in addition to the institution's risk profile. This risk-based approach must be articulated clearly, particularly in its application to community banks. So again, tailoring is about making sure that there's an appropriate approach given the size, complexity, and resources and risk profile of each individual institution. But historically, it's been the case that community banks have said, look, we're not, we don't see the tailoring because we get questions and we get expectations that are more along the lines of larger community banks, regional banks that are much broader in terms of scope and expertise than what we're doing at our smallish bank. Governor Bowman goes on and says, in some cases, community banks face less stringent standards than large banks, but there is more we can do to ensure that our regulatory and supervisory approaches are appropriate for the limited risk these banks present to the banking and financial system. Our current work includes reviewing the merger and acquisition and de novo chartering processes for community banks, including streamlining applications and updating our competitive analysis framework to better assess competition among small banks. This is great news for the community banking industry, especially in the M&A component to that industry. It's been a long time that we have seen bank mergers and acquisitions uh, really be held up and hampered in some ways by the regulatory approval process. And it's not that the agencies were doing anything inappropriate or wrong. It's simply that the analysis was not always as tailored or streamlined as maybe it could have been. So that approach is changing under Governor Bowman. She says, as we're considering changes to the broader framework, we have an opportunity to shape our regulations and supervision in ways that recognize their important role in meeting the financial needs of the U.S. economy, including the most remote and rural places. We're also in the process, okay, so we've talked about M&A and applications. She says we're also in the process of reviewing comments on proposed changes to the community bank leverage ratio that would provide greater flexibility but maintain strict capital standards that are nearly double the minimum capital requirements. And I think part of the theory behind the community bank leverage ratio is that it's intended for less complex, less risky institutions. It's one ratio to focus on as opposed to three or four ratios. And it's a more stringent requirement, but it is an easier methodology and calculation and so forth for institutions that do not have different levels of complexity or significant levels of complexity. She says these changes will help to enable community banks to focus on what they do best, supporting local communities and lending to households and businesses. We will also soon revisit the mutual bank capital framework to ensure that it provides flexibility while ensuring safety and soundness. Okay, so this mutual bank capital framework is a little bit different, and expectations are, I think that the capital expectations will be tailored again to that kind of unique institution. Mutual institution is a non-stock institution. In other words, it's owned essentially by the depositors that deposit at that mutual institution. She goes on, in addition, we're well underway. This is good. This is encouraging. Well underway with work to modernize regulations for large banks. Okay, so moving from the community banking sector up to the large banks in terms of revising the four pillars of the capital framework: stress testing, the supplementary leverage ratio, Basel III, and the GSIB surcharge. So first, stress testing. She says our recent proposal provides transparency by disclosing stress test models, the scenario design framework, and 2026 scenarios. Our goal is to reduce volatility, balance model robustness with transparency, and ensure that significant future changes receive public input. We published the final 2026 scenarios earlier this month, earlier in February. With respect to the SLR, last fall, together with the OCC and FDIC, she says we finalized changes to the ESLR for US GSIBs, so the biggest of the big. These changes ensure that the leverage requirements serve as a backstop to risk-based requirements as it was originally intended. It will also prevent the leverage ratio being an impediment to banks engaging in low-risk activities like holding treasury securities due to the binding constraint. On Basel III, she says, and reiterates again, together with the FDIC and OCC, they're in the process of advancing Basel III implementation. Finalizing Basel III, she says, reduces uncertainty and provides clarity for bank capital standards, enabling banks to make better business decisions. Our approach includes a bottom-up rather than a reverse-engineered predetermined outcome. We've been faithful to the goals of supporting market liquidity, affordable home ownership, and bank safety and soundness. One way we have addressed this is through adjustments to the capital treatment of mortgages and mortgage servicing. The existing approach has reduced bank participation in mortgage lending and has limited access to credit from banks. These changes will benefit institutions of all sizes. So, with respect to Basel III, she's demonstrating a level of confidence, which is good, with respect to reducing uncertainty and providing the banks that will have to be complying with the full Basel III framework, providing them more clarity and clearly indicating some of the administration's priorities around affordable home ownership and market liquidity. On the GSIB surcharge, she quickly says, in coordination with the Basel proposal and other capital reforms, we're also refining the GSIB surcharge framework. The surcharge must balance safety and soundness with economic growth, ensuring that banks can continue to support the business and consumers, thereby supporting the broader economy. Then she turns to supervision, which is, capital components, the M&A, those are all critical. But supervision is where we've seen a little bit more of Governor Bowman's priorities set forth. We've talked about that in a previous episode, and she refers to it again here. She says, "I'll turn now to our supervisory priorities and what's on the horizon." She says, "Last October, and for the first time, the Federal Reserve published supervisory operating principles. These principles provide direction to our examiners to prioritize core and material financial risks to safety and soundness." Again, the focus is on the material financial risks. "We will continue to conduct all of our examination programs, but when we are identifying and prioritizing risks, we will focus on those that can lead to a deterioration in the financial condition of a bank or a bank's failure, rather than paying excessive attention to processes, procedures, and documentation," which has been, I think, some of the perspective that banks have experienced over the course of the last few years, few decades, what have you. There hasn't been quite this pinpoint direction to focus on material financial risks. She says it's not a fundamental shift in our supervisory approach. It's moving from siloed compliance exercises to unified forward-looking risk assessments. Our examiners must engage in ways that ask what vulnerabilities would lead to the failure of the institution rather than simply, are these policies properly documented? Now, this is certainly important for our banks to pay attention to in terms of the operating principles and how that may be reflected in examinations going forward. But it is still the case that policies do need to be properly documented, and compliance officers should be keen to continue with the regularly scheduled updates to policies and procedures and documentation, and continue to document, because it may not always be the case that the focus is primarily going to be on material financial risks. There are other components that are not necessarily fully material financial in nature that are related to things like the CAMELS ratings. So just a word of a little bit of caution there, that policies, procedures, documentation is still important, but perhaps maybe not the primary focus from a risk-based approach going forward from the Federal Reserve. She says, "Consider how this works in practice. Too many MRAs, which are matters requiring attention, today cite policy documentation gaps, committee attendance issues, or immaterial limit exceedances. While these may technically violate a standard, they rarely predict institutional failure. We're now asking the examiners to shift their focus from 'is this documented' to 'what scenarios could cause your strategy to fail, and are you prepared for them?' This approach demands more sophisticated analysis and reasoned judgment from our examination teams, but it will produce more meaningful supervision that truly protects safety and soundness." Very interesting approach, and I think very welcome from the banking industry, especially the community banking industry, where they don't have quite the resources to sometimes deal with all of the expectations around processes, procedures, documentation, and so forth that have been at the forefront of their credible challenge, I guess, to examiners in the past. She says, "If you have recently experienced the Federal Reserve Safety and Soundness exam, you should be able to plainly see that we are putting these principles into action. We recently notified all state member banks and holding companies that we have begun a comprehensive review of all outstanding safety and soundness MRAs." Again, matters requiring attention. "This review provides the necessary context to identify what truly matters for institutional safety and soundness, determine what does not, and course correct where supervision has drifted into procedural compliance over material risk assessment. Where MRAs do not meet standards, we will downgrade them to non-binding supervisory observations. We expect to complete this review by the end of June." Okay, so we have some timing that we're talking about here. This is good, and this is helpful for community and regional banks, or really any banks that have experienced the addition of MRAs or MRIAs or similar, and where they focus more into processes, procedures, documentation. She says, Let me be clear in closing. Emphasizing core and material financial risks to safety and soundness does not mean neglecting non-financial risk. Cybersecurity, for example, remains a top priority. Strong risk management remains essential to the safety and soundness of the institutions we supervise, and we will continue to issue findings and examine for it where appropriate. She goes on to thank the crowd and the invitation, but then she concludes. And so wanted to really use the remarks to highlight what we've been seeing in the market generally from bank supervisors with respect to issuing new regulations, which are the rules by which banks are governed and examined, but then also the supervisory function. The supervisory function is really the examination function. Supervision is the same as examination. And so what we see here again is following up on the release in October of the supervisory operating principles, reiterating, even doubling down on those, and adding a little bit of the element of timing expectations to address MRAs that, in light of the supervisory operating principles, should no longer be in force. She does carve out a little bit at the end the remaining need to continue to be vigilant on non-financial risks because there are non-financial risks, but clearly the focus going forward will be less so on the soft risks and more so on what things could happen, what impacts could occur that would result in the potential failure of your particular financial institution, your bank. That seems to be where the focus will be from a financial perspective and from an operating perspective. So with that, I'll conclude. If you have any questions on this podcast or any of the others that we've done together, please reach out to me at jsylvia@dwaynemorris.com or reach out to any of your other favorite Dwayne Morris lawyers. I'm always here to help. You know where to get me. Again, thanks for paying attention. Thanks for listening. If we can ever be helpful, please let me know. And with that, please again like and subscribe the podcast wherever you get your podcasts. We're up on YouTube as well now. So for many of our episodes, we'll be starting with video, and going forward should be more education and hopefully a little bit entertainment as well. Thanks. Have a great day.